Welcome to TFE Talks, Navigating Wealth, Business, and Legacy, the podcast from Thomas Fisher and Edwards. Each episode, our attorneys bring you expert insight on estate planning, business strategy, and legacy building, breaking down complex topics into clear, actionable advice. Whether you're solidifying a strategy we've discussed or preparing for what's next, this podcast is your resource for thoughtful, practical planning. You ready? Let's dive in.
Hello and welcome to today's edition of TFE Talks, the podcast from Thomas Fisher and Edwards. I am your host, Jordan Goewey, and I'm joined today by my friend and colleague, David Thompson. David is an attorney here at Thomas Fisher and Edwards and has been since 2018. He is a graduate of Case Western University, where he graduated as the all-time leading shot blocker on the basketball team, and also finished up with a master's in accounting before going on to the SMU Dedman School of Law, where he got his law degree, and also graduated from the University of Alabama School of Law with his LLM in taxation, which is also where I got that degree. David, happy to have you join us here on the podcast today, and look forward to talking to you.
Yeah, absolutely, Jordan. Happy to be here. Looking forward to it. I think we've had a good topic today.
Yeah, so the topic that we're going to discuss is just a general overview of the estate and gift tax system in the United States, which is a broad topic, and there's a lot of different directions we could go. But in this particular episode, we just want to give sort of a broad overview, because this is something that I have clients almost always ask about, whether it's something that is ultimately relevant to them or not, because it's something that gets talked about on the news. It gets presumably written in the papers, though no one reads papers anymore. They listen to podcasts instead. And so how does the estate tax system work in the U.S., and is it something that actually affects people?
Yeah, that's a great question, Jordan. So I'll kind of start with just a general overview of the estate and gift tax. And I'll kind of start with the idea that the estate and gift tax regime is essentially a wealth transfer tax. Okay. So from the estate context, what that looks like is when someone passes away, they take a look at, and when I say they, the government, they take a look at everything that person owns or controls, and they assign a value to it. To the extent that the value exceeds certain levels, and we'll talk about that in a minute, the IRS and the Internal Revenue Code will impose a tax on that estate. Now, the gift tax is functionally the same type of transfer tax system. However, it applies during a person's lifetime with respect to gifts that they make. So, for example, if a person transfers wealth to their friend during their lifetime, it could potentially be subject to gift tax. Now, there are a number of exceptions to this general rule imposing an estate or gift tax, whether at death or during lifetime, on these transfers. The first larger kind of exception to that rule, and something that people are generally familiar, is what I'll call the estate tax exemption, and it applies to gifts as well during lifetime, but it's essentially a credit, right? So under current law right now, there's a $13.99 million estate tax exemption that can be applied towards wealth transfers, whether that be during your lifetime or at your death. So functionally, if you're a single individual, you will not pay, at your death, if you have less than that amount of assets that you own or control, you will not pay an estate tax if you were to die in 2025. You could also transfer up to that amount without incurring gift tax during your lifetime or this year in 2025. So that's kind of a general overlay of how that transfer tax regime works. But there's obviously...
Yeah, I mean, $13.99 million is a lot. I mean, there are some people out there who are fortunate enough to have estates that large, but with it being, so much, that seems like it's something that wouldn't affect many people. Has that always been the case? Has it always been as high as it is now?
Good question, Jordan. The exemption has increased over the last, I would say, historically over its lifetime. To my knowledge, I'm not sure that the exemption's ever actually gone down. There was a 1 year where there was not an estate tax necessarily that was imposed, but the exemption has never been reduced. when you're looking at the estate tax exemption as it currently exists, if you go back to before the Trump administration, it was roughly half of what it currently is with some inflation adjustment. The first Trump administration passed the Tax Cut and Jobs Act, which greatly expanded the estate tax exemption and essentially doubled it. Now, under current law, that is scheduled to sunset here at the end of this year. I know with the Trump administration coming back in a second go around here, there's a lot of thought that maybe they could be extended and that may not sunset and be reduced in half so that you would have, roughly 7 per person. But I think we'll talk a little more about that and whether that may or may not happen.
Okay. And if I understood you correctly, the estate tax exemption is also tied in with the gift tax exemption. So if I make gifts, I'm using up part of what I could eventually use for my estate. So does that mean that when I make gifts to my son for Christmas, am I just burning through my exemption without really knowing it?
Yeah. And I think that's actually something that the Internal Revenue Code addresses. So there are a number, in addition to the big exemption that we have, right, that would apply to kind of large transfers of wealth. We have a couple of other exceptions to the general rule that would impose an estate or a gift tax. In the context of gift tax, the most common one that we see and one that people are kind of inherently familiar with is what I will call the annual exclusion. And essentially, the annual exclusion is a de minimis amount, a small amount that the IRS says we're just not interested in tracking these kinds of wealth transfers between taxpayers. It's not efficient. We don't have the capability or the manpower, whatever the reason may be. We're not going to track these. In 2025, the annual exclusion amount is $19,000 per person. So for a married couple, that would be, you each have your own annual exclusion. That would be $19,000 for one spouse and $19,000 for the other spouse. So you can effectively make gifts of $38,000 to an individual potentially without incurring any gift tax filing obligations. Now, note, if you were to exceed that amount, it's not that you would pay gift tax. It's just that you would utilize some of that larger credit that would be not available for you when you go on to pass away or make further subsequent gifts during your lifetime. So it's very flexible, but you can really take advantage of that and leverage that up. Places where you see that leveraged up, for example, is with grandchildren. Frequently, people will engage in annual exclusion gifting, whether that be through like a 529 plan or potentially a custodial account of some sort, or maybe even a small trust that's designed to receive annual exclusion gifts.
And so I can make those gifts each year. And then I think I've also heard something about certain gifts that I can make related to education or health. And how does that tie in with the annual exclusion or the exemption amount?
Yeah. So there are two other types of transfers that are deemed not gifts, essentially. And essentially this designation as these transfers not being gifts comes from just a policy consideration that we think these things are a good idea, right? We want people to take these actions. So the first one, like you mentioned, is qualified educational expenses. Generally, this takes the form of tuition, but there are some other things that can potentially fall in this category. But for example, let's say my grandchild is attending Clemson and their tuition is $20,000 a year. Well, let's say I'm engaged in making other annual exclusion gifts to this child from some other method, giving them $19,000 in a check at Christmas or something like that. Well, I can actually remit payment for the student's tuition directly to Clemson, this example, and it's deemed not a gift. Now, the important consideration there is that it goes directly to Clemson. I can't necessarily just give the kid the money for him to turn around and pay Clemson. I've got to give it directly to the institution there to qualify for that exemption, but it doesn't count towards your annual exclusion, and it won't utilize your larger credit amount that's currently $14 million.
So, I mean, it seems like there's a lot of options here for sort of, getting things to individuals without tapping into the exemption amount. And even then, the exemption amount is so big. How about gifts between spouses? Is that something that is important? Particularly since a lot of spouses are probably treating all the assets as if they are shared anyway.
Yeah. And before I mention the spouses, I'll just mention that there's a matching exception that's for medical expenses that's very similar to the qualified educational expenses, and you can utilize that in much the same way for an individual's medical expenses if you direct that payment directly to the institution. As it relates to the marital question, another exception to general imposition of their state or gift tax is what's called the marital deduction. So you can essentially make gifts between spouses, spouse one to spouse two, without incurring a gift tax if it's during lifetime, or a state tax at death. Now, there are a number of limitations and qualifications to how you qualify for a marital deduction if it's not just, hey, I give the spouse the money. And there may be other income tax considerations that you want to take into play. But the main one is that functionally you can, at death is mainly the key place you'll see this. You can essentially largely defer a state tax payment until the second spouse passes away, because functionally the government looks at a married couple as if they are one kind of unit for purposes of levying the estate tax. So there's lots of planning opportunities that arise there, and good planning will take advantage of this marital deduction, so that even if we're well in excess of the estate tax exemption, we're likely not going to pay estate tax at first death.
And so how is the IRS tracking all of this, as far as how do they know that I'm making gifts? And is it something that I have to let them know about, like I let them know how much income tax I owe them each year?
That's a great question. So when you think about how they track the estate and gift tax and what exemption levels you have left, I think this is something that's very important about the annual exclusion that kind of goes without being. A lot of people know about the annual exclusion, but they don't know the effect of going over it. Well, even if we're not going to pay, let's call it gift tax, right? We make a gift and transfer $100,000 to an individual. Well, even if I'm not going to owe gift tax because I have all my, almost $14 million of exemption this year. The amount that exceeds the annual exclusion actually means I am required to file a gift tax return. So, and essentially the amount that's over my annual exclusion, that's going to reduce the exemption that's available to me at my death or when I make a subsequent gift. So you're correct that when we make larger gifts that exceed the annual exclusions, or maybe the gifts that don't potentially qualify for the annual exclusion, considering a gift to a trust or something that doesn't qualify, you may have to make, you likely may have a filing obligation, even if no tax is paid. And we see that routinely as something that clients miss because they're thinking, well, there's not going to be a tax. Well, the code sections still require that you file this return because it's functionally an informational return, right? The government's acquiring information so that when you do pass away, they know how much exemption you have used, because your exemption that you have available is really a moving target to some extent. And it's not really known until the decedent or taxpayer passes away, right? Because it could be higher or lower than what we have today.
And so just kind of summarizing what we've talked about thus far, an individual has a $13.99 million exemption, so call it $14 million. So that's roughly $28 million for a married couple. And then in addition to those very large exemptions, they are also able to make as many gifts as they want, up to $19,000 per person, or per
two separate individuals, right?
Per recipient of the gift. Correct. They can pay for education and tuition and medical expenses for any individual that they want, so long as it's paid directly to an institution. And they can make transfers between them and their spouse freely. So there's a lot of options here before you even tap into that $13.99 million exemption. So it seems like for a lot of individuals, we've got tons of options and ability to control paying the estate tax. But it seems that the one big thing that you touched on early that may affect things and at least call more of this into question for individuals is that idea of the exemption coming down. So what causes the concern there, and how likely do you think it is that the exemption actually comes down?
Yeah, that's a tough one, and to some extent, I think the question is a little bit of a black box. I don't know that really anybody knows with real certainty what will happen. Before the most recent election, I think that there was a lot of talk in our tax communities that the exemption likely would be coming down, maybe sunsetting to the pre-Tax Cut and Jobs Act level, which would be roughly half of what we got now, maybe with some index for inflation. So let's just call it $7 million of exemption per person. So there was at least that thought. Now with the Trump administration incoming, I think there's a lot of tax practitioners that and other, commentators that believe that the Trump administration is going to work very hard to extend what were otherwise temporary tax rules, right, regarding the exemption amount, and try to kind of save what they would look at as one of their seminal pieces of legislation from their first administration. So I think that there's a lot of thought that the Trump administration will seek to extend through at least when his term expires. And we would have some sort of short-term extension where we maybe maintain the current levels of exemption with index for inflation. However, if anyone is really certain of that, I would question how they can be so certain. I think it is truly an unknown, and there's a lot of history of tax bills that get passed very late in the year, right, which have effect moving forward to the next year. So I don't know that this area of uncertainty about what exemptions may do is really going to be answered in the immediate future as we sit here in February of 2025. But, maybe towards the end of the year, hopefully we'll have some clarity on what will happen, at least for the next few years. I will say, if you go back to the Biden administration, there were at least proposals that were put in at that time that would lower the exemption to about $3.5 million per person. So there have been at different times with competing administrations very different views on what this exemption should be and where it's going. I think when you look at the budgeting realities, whether it's 5 years, whether it's this year, whether it's 10 years from now, I think over a longer time horizon, I think it is likely, given the growth of these exemptions and how, few people it functionally impacts, is likely that at some point we will see reductions in these numbers. It's just a question of when.
So there's certainly going to be some uncertainty here for several months or potentially even several years if I followed you correctly there. And did you mention exactly what would it fall to if the current law stayed in place as is?
Yeah, it'll be but roughly half of what it currently is. That's $7 million approximately, with some index for inflation.
Yeah, and so then that puts you at around $14 million for a married couple, which is certainly going to affect more people than it would otherwise.
Correct.
We're wrapping up here, but a key part of this podcast, a key goal of this podcast is to provide actionable advice. So when you're talking about a topic like this where there's so much uncertainty, and I'm sure in future episodes we can talk about specific ways to address that uncertainty and address actually, efficiently planning for estate taxes. But just based on this general overview, I would say that it seems like the actionable advice would be meet with an estate planning attorney, meet with someone here or with your estate planner and discuss the uncertainty and ways that you can sort of have flexibility and be on top of your planning heading into 2026 here. Is that your main takeaway as well?
Yeah, Jordan, I think that's consistent with what I would recommend. I mean, I think that the issue we're going to see, especially for clients that are at or near that exemption level, is that as we get closer to, maybe it's this year or maybe it's 5 years from now when these exemptions come down, I don't know. But as we get closer to these jumping off points, the availability of good practitioners is going to be in short supply, is what I would tell you. And they're going to have a lot of demands on their time. So I think even, while the exemptions are high currently, maybe getting in for that initial conference with an estate planning, practitioner or tax attorney is valuable from setting a relationship. So you have someone that, can, help you navigate kind of what these changing times look like. I think for clients that are, comfortably below the exemption, but maybe are kind of in that middle area between maybe could be taxable if it sunsets, they're kind of in a wait and see mindset where they need to constantly be evaluating and making sure that there hasn't been changes to the laws. And I think to the extent they can take advantage of some of these less complex gifting strategies to kind of manage the size of their estate, I think that can be a very effective strategy. So hopefully they don't have to engage in more complex strategies down the line to minimize an estate tax.
Yeah, that makes sense. Well, I think this has been a terrific overview of the system, and I'm sure it will sort of set the foundation for a number of topics that we can discuss on future episodes of TFE Talks. So, David, thanks for joining me today, and I look forward to having you on in future episodes.
Thanks for listening to TFE Talks. For more information, please visit our website at www.tfelawfirm.com. You can also follow us on LinkedIn, Facebook, and Instagram by clicking the links below in the show notes. If you have any questions about topics discussed in the episode, or you have recommendations for future topics, please email us at info@tfelawfirm.com. See you next time.